Hi everyone. Today, we're talking about two of the most important orders in trading: stop loss and take profit. These two simple tools are actually the main pillars of risk control, something every trader must master. So, let's dive in. Stop loss, also known as a loss limit, is a simple but powerful order that automatically closes your trade if the market moves against your prediction. Think of it as a protective shield for your capital. Take profit, on the other hand, is the order you set when you want your trade to automatically close once the price reaches your target. So your profit is locked in without you having to watch the charts all day. Let's go through a quick example. Imagine gold is trading at $4,000 and you open a buy position, expecting the price to rise to $4,020. You set your take profit at $4,020. $4,020. So when the price hits your target, your trade closes automatically and your profit is secured. But the market doesn't always move as expected. That's why you also need to protect your capital with a stop loss. If the market goes the other way, your stop loss automatically closes the trade to prevent bigger losses. In this example, you could set your stop loss at $3,980. If the price drops to that level, your position closes automatically, protecting your capital before the loss grows larger. These orders might sound simple, but in practice, they're the real key to consistent and professional trading success. If you know how to use them correctly, you've already covered half the journey toward becoming a successful trader. Remember, risk management isn't just about protecting your money. It's the real path to growth and longevity in the financial markets. If you found this video helpful, share it with your trader friends. And don't forget to subscribe and hit the bell icon so you never miss an update.